Trade has been the biggest drag for earnings for global profits over the course of the last 12 months. And if we continue to see de-escalation, I think that's going to drive upside surprise. And I think that gets us to that 3,200 level sooner rather than later.
Earnings have been better than you expected?
Better than expected. I think you're basically seeing some form of troughing taking place in 3Q, stabilization in 4Q, and I think you see a recovery in the first half of 2020.
Too strong to say you're calling a bottom. You're calling a bottom in terms of growth and earnings.
Yes. I think the big call here is on the business cycle. You know, do we see some form of recovery in the business cycle, which has been slowing down in the U.S. and global for the last 18 months? Asia, and specifically when you look at, a lot of the data coming out of China and so forth, I think the second derivative has been improving. Liquidity data has also been quite supportive, largely because of easier monetary conditions. And I think we're sort of at an inflection point, positive inflection point.
You agree, Liz?
I agree that it's positive to see earnings coming in better than expected, but the bar was pretty low. So I don't know that it was going to take much to get there. Unfortunately, we're not going to know if they've bottomed yet until we start getting reports in the next quarter. So some of the positive surprises that I think could take us into breakout phase here are if we see PMIs actually bottom. So if we have PMIs come in and improve this month, if we see GDP surprise to the upside this week, we're getting an advanced number. And if we have an actual tangible trade deal, not just talks about it.
You must be getting more positive, Weiss, based on your buys in the market. If you keep adding to your position in the SMH, that can't be from a position of defense.
No, it isn't. It's from a position of offense. I don't see any tangible bottoming, though, other than hope. And, we haven't gotten a PMI in the last week. But clearly, the data is kind of squishy. So time maybe creates the bottom. Maybe it's the unbelievable liquidity, but I think we've also discounted it. So as I look at the market, though, and I was going through the numbers today, over the most recent bull markets extended of 7 to 9 years, you had gains that exceeded what we've had in this 10-year. So the average gain over 2009, 2019 to date is 14%, with the market up 150%. If you look at 91 to 99, his average annual gains 21%. The market doubled. And then if you go back to 82 to 89, you're at 19% with 152%. So we're not so out of line that we can't keep going. I'd also add that interest rates were not as low then as they are now. So I think you've got enough set to take the market higher, but it comes back to trade. And that's what it all turns on, not in the Fed, purely on trade.